Alright guys, welcome back. It's LSP. It's currently the 8th of September 2019. So this is answering member questions, and this is for Davidman, who's been asking some questions, regarding the Euro USD chart. Not this one, but a previous post that I did, and then obviously we had a little exchange of ideas. And today, David, you sent me you do map liquidity levels right down to the 15-minute time frame. Perhaps from what you have said, this is why I have issues with direction impatience. Your point about not rushing into trades is well taken and heeded. That's great. Also, for the most part, I tend to ignore liquidity levels that are months old. So I'm going to break this down, but sorry, and I'm reading it out loud. Sorry. Okay. How do you determine the size of liquidity levels in balances regards, David? Okay, so first things first, okay, you've put here you do map liquidity levels right down to the 15-minute time frame, okay, and I think this is part of the problem. I'm not going to talk about the person, but there's a person out there who teaches this very thing, okay, to start on the monthly and do the weekly and go down to the daily and go down to the 4-hour and the hourly and the 15 and it's too much. It's too much. When you do that, you miss what's right there in front of you. Okay, and then you tend to do what you're doing now. You tend to ignore the higher time frame levels, and you put way too much weight on the lower time frames, and that causes not only impatience because you're not sticking to the higher time frames, but it actually quantifies and cultivates that impatience by not staying on the higher time frames. If you stay on the higher time frames and you allow price to do its thing, which you'll see in the Euro JPY study that I'm going to be doing with you guys, over the course of the next week and months and 2 months, whatever, however long it's going to take, to eventually arrive at a really nice quality setup. You'll see I'm not going to bounce around on the lower time frames until something makes sense. So I'm going to force anybody that's paying attention to Euro JPY study that we're doing, or that I'm doing, to stay on the higher time frames. You've got no choice if you want to learn what it is that I'm trying to show on these, on that particular pair that we're going to be tracking. Then you have to just deal with it. Do you understand? So you have to stay on the higher time frames until you cultivate enough patience to not keep going down to the lower time frames. You have to stop yourself from doing that, because when you go down to the lower time frames, you miss what's going on the higher time frames. For example, if you look at the range, okay, and I'm just going to do this loosely. If you look at the range, okay, say from, just for argument's sake, from here to here, it's around about 300 pips, okay? So on the weekly, it doesn't look like a big deal. But then when you drop down to the lower time frames, even a weekly candle, okay, which is maybe 50 pips, for example, when you're dropping down to the hourly, it still looks okay. But as soon as you drop down to the 15-minute chart, you've lost the relationship between a weekly chart and, say, the daily chart, yeah, which is still quite close enough for you to stay within the range of the weekly chart. If you go from a weekly and you drop down to a 15-minute chart, you're so out of whack, yeah, that whatever you're looking at on the 15-minute chart, the levels may not even show up on the weekly. So then your mind switches and says, okay, well, I'm looking at a 15-minute chart, so that swing point makes sense, that candle makes sense, this level's still in play. Do you understand? So you start to look at the 15-minute chart like you're looking at the weekly chart, yeah, that it has all the weight in the world, and you're solely using the 15-minute chart to base your ideas from, instead of using the higher time frame levels to base your ideas from. So what I'm getting at is, and again, to really emphasize this point, if price is coming up here, for example, and you've got this level noted, it doesn't matter why, but let's say you've got this level noted up here and price comes up to it, that's when you need to drop down to the lower time frames and start paying attention to the 15-minute chart, because you're looking for entries. I've always split my time frames into two types: my analysis timeframes and my trading timeframes. My trading timeframes, okay, are confirmation, okay, of a higher time frame level. So if I'm looking at the weekly, the daily, and the 4-hour, okay, these are all analysis timeframes, and I'm waiting for that moment. Okay, that makes the most sense. When I drop down to the hourly, though, the hourly chart, I never use the hourly chart as an analysis time frame. I use the hourly chart, okay, for confirmation that my higher time frame ideas are indeed correct. Okay, so the hourly helps me confirm these higher time frame ideas. Okay, then I drop down to the 15-minute chart for a potential entry, and I can use both the hourly or the 15-minute chart, but I never drop down to those time frames until it makes sense for me to do so. Okay, so that's that. Your point about not rushing into trades is well taken and heeded. That's good. For the most part, try to ignore the months. Okay, so this bit here, you tend to ignore liquidity levels that are months old because I assume that these have dried up. This is incorrect. This is something that you need to kind of move yourself away from, because just for argument's sake, if we just go over to the monthly, and let's say you've got an old a level down here. So we'll use this one here. Okay. Now this is miles away. Okay. So I want to make the distinction here. If you're saying levels that have already been traded to, so for example, that low right there, okay, price came up, it traded through it. Okay. So it's exhausted whatever liquidity was there. Okay. It's all been used up, dried up, as you say, and then we had a really nice reaction away from that. And now we started to grind a little bit lower. So if price comes down here, we're not going to be paying attention to this particular level because price has fulfilled an objective when it went down through that level here. But as price is moving, it's creating more levels, it's creating more imbalances, it's creating other levels of interest, okay? And these are things that we need to pay attention to as price is, again, revisiting these levels. And remember, the relationship between the monthly chart, the weekly charts are massive. These are big time frames, okay? So you have to be very careful, when you're looking at the monthly charts and the weekly charts, to remember, right, that these levels take a very long time to form, okay? So what might be 2 or 3 days on an hourly chart, okay, is months and months and months of time, possibly even years, before price even comes close to another level. So for example, you see this candle right there, okay, and I'm going to make a note of this candle, okay? This candle right here was respected. This is the order flow shift, okay, on the monthly. It was respected, okay, and then it's obviously been grinding low. If price gets back up to there, you can bet your bottom dollar that price is probably going to respect this level again, okay? So I don't think it's a difficult one because you can't gauge and say there's a definite scale. So if for when a level stops becoming useful. So you can't say, well, it's 5 times. So if price hits that level 5 times, then that's it. It's dried up. It's done. Then we can move on. Okay. You have to look at the reaction at these levels because we're not, unfortunately, mind readers. Yeah, we can't quantify something like that. We have to just say, look, I'm going to let price hit this level. I'm going to see what happens. We can guess. We can have educated guesses. We can look at price objectively. We can look at these things and say, I'm expecting price to do this, and this based on the way price is moving. But once it hits it, that's when we start to pay the most attention. I think one of the biggest problems, is not, I don't want to say problems, but I think one of the biggest challenges for people is when I start to post these things, because I've done this before. Okay, I've done this before, but I was posting for years on a particular forum, and showing lots of different things, and similar to some of the comments that I've already had. How do you get directional bias, how this, how that, how you seem to be on point most of the time. It's a function of reading price. It's a function of being able to look at price and see where the orders are, see where the flow is, to understand why price is doing what it's doing, and arriving at that moment where it's logical that price should be going in that direction. This takes time. It takes time, patience, and a willingness to understand this stuff and to really study it. I mean, I can't speak for you guys, but I can speak for myself. I know that if there's over the last, say, 6 months, for example. In fact, no, over the last year and a half. Last year in January, I started a swing trading system. Okay, I started building a swing trading system methodology. Okay, and it's taken a year and a half for me to even gather, enough data to start breaking things down. I mean, this is going to take years for me to put that system in place. But I'm really anal. I mean, I will break things down. I will look at things wick by wick, by tail, by candle, minute by minute. Whatever it takes. And I will break. If I see something and I want it to make sense, I have to break everything down and then infuse it with something else and put those two things together and see if it works. And if those work, then I put a third thing together and I see if that works. And I keep doing this and I keep doing this and I keep doing this until eventually I arrive at something that makes sense. How many people, do that? I can't speak for anybody else, but what I'm saying is this stuff takes time and you have to have a willingness to be able to go through it, stay on the higher time frames and have the patience to stay there until you start to understand the relationship between the higher time frame levels and the lower time frame levels, okay? So that's that. interim volatility, right? So you put here, I take it for granted that interim volatility will provide many trading opportunities rather than considering these possible long-term targets. Well, you can do both. You can look at higher time frame targets or levels, okay, and wait for price to do its thing as price is drawing, because remember, it's a function of your time frames. It's a function of what you're looking to do. You know, are you wealth building? Are you looking to, you know, as an income trader? You know, so you can do both. You can respect the higher time frame levels, okay, but you can also look at the lower time frame levels, like for example the daily, the 4-hour, and the hourly, you know, and use the 15-minute chart to take a trade from, and you know, increase the quantity of the trades that you're taking. You know, so you can do both. You can do both. The one thing that I will say though is if you take your trades based on higher time frame levels, okay, then you will find better quality trades that tend to work out a lot more in favor than jumping down to the lower time frames. For example, the hourly, the 15-minute, and the 5-minute. You're going to find you'll probably find you'll get bounced around a lot, and you'll end up, you know, possibly with a 50-50 system break even, or even a negative, you know, a negative risk reward. You know, on your entire system or methodology. So you can take advantage of interim volatility, but it has to be specific. You've got to be very careful how you're doing that, and especially trading around news as well, right? Which I'll just throw this in there now. You know, when you're trading around news, it's not a bad thing. People think it's a bad thing. NFP is. NFP and non-farm, you know, and FOMC, forget those. I'm talking about trading around quality news events that make sense. Okay, maybe on a Tuesday or a Wednesday, possibly Thursday. You know, you get some nice, you know, nice news comes out. You get a nice injection of volatility. You understand where you are, you know, in the overall picture, and maybe you pick something up on the hourly or the 15-minute chart. You know, based on a 2 or 3 day, you know, move. You know, and you get a nice 20-30 pip trade. So again, I don't want to veer off too much, but you can take advantage of these things. But again, you've got to be careful. You know, me personally, I prefer to just trade off the higher time frame, weekly, daily, 4-hour, and then I'm looking for the hourly to confirm, and a 15-minute entry or an hourly entry. All right. How do you determine the size of liquidity levels and hence the imbalances? Again, it's all higher time frame based. So if I'm looking at the monthly chart and I'm looking at this level down here as a possible, you know, level of interest, then I mean, this is a monthly chart, so I'm looking at a massive level that makes sense. Okay, if I was looking at, say, a 15-minute imbalance, okay, and let me just read your question again just to make sure I got that right. You determine the size of liquidity levels, yeah, and hence imbalances. Determine the size of liquidity. Yeah, so I was right. So determining the size, it's a function of the time frame that you're looking at. So if I'm looking at for a monthly liquidity pool level area of interest where I believe there is an imbalance, okay, then that range is going to be much larger than a 15-minute imbalance level, liquidity pool, and so on. Okay, so again, that's the function of the time frame that you're on. If you're looking at the weekly, daily, and the 4-hour, they tend to, especially the weekly and the daily, they tend to fuse together nicely. Okay, because the ranges are not so far out of whack. But to give you another example, if you're looking at the weekly and you're dropping down to the 15-minute, you're so out of whack with the ranges and the average ranges that you're dealing with. Okay, that it becomes very difficult to know where you're at, because you might be within a weekly level on the 15-minute chart and you get 19 bars on the 15-minute chart with some consolidations in between that, you know, that move, you know, and still be within, you know, the weekly level. So you have to factor that in. It's time frame based, depending on the time frame that you're on. Okay, and I think that's it. So let me just clean this up a minute. Nope, can't remember what were we on? Yeah, we was on the weekly. Okay, so I hope I've answered your questions. I think I did. Just having a quick read through again. Yeah, I think that's it, Dave. Or David, sorry, David, man. So look, I hope it helps, man. I hope it helps. And obviously, as always, if you've got any other questions or you need something else answering, whatever, let me know. And I'll just say I appreciate obviously that you're commenting on the thread. It's very very good. I'm just having a quick look through. Pairs. Okay, so that was that's fine. I was just seeing if I could throw something else in here from another member, but that's fine. So that's just you. Cool. Okay, so I said I'll do your video, so that's your video done. Sorry, David, man, just give me a second. I just want to make sure that I'm not missing anybody else. And I answered one person, which was PZW. because I might be able to throw it in this video as well. And then I believe, yeah, so the other member was just asking about the pair that I was going to be using. So that's fine, yeah. So like I said, man, I hope it helps, you know, and, you know, keep me posted, man, keep me posted. You know, like I said, I think, you know, you're no different to most traders. You know, I went through it myself. I've been trading for 23 years, so I've gone through quite a lot of crap. And I think one of the biggest fallacies in trading is that there's too much focus put on the you know, on the trading system, the methodology instead of the trader. And I've always found over the years as well, if you know, meet somebody who can explain something to you in a way that makes sense, you know, a perfect example is, you know, Sherlock Holmes and Dr. Watson. I know it's a bit weird, but you know, if you watch some of the older Sherlock Holmes series, not the new ones, but some of the older ones, you'll find the same theme pops up. You know, Dr. Watson just doesn't get shit. But then as soon as Sherlock Holmes explains it, he's like, okay, now it makes sense. Okay, and it's exactly the same with trading. You know, sometimes you just need somebody to just point something out in a way that you understand. Yeah. And then it just clicks. It just clicks with you. So, look, man, I'll leave it at that. Don't want to ramble on too long. And again, as always, I hope the video finds you and everybody else well. Any other questions, let me know, and that goes for all, you know, all the people on the thread. And in the meantime, I'm going to shoot off, and I will speak to you guys soon. Take care.